I don't know what it says about our panel today and our subject matter when we've had a couple of dropouts. First of all, or at least a shift, I don't know what it says with Mike Kirk having moved from the private equity panel to the capital markets panel, and Kevin O'Hara having to drop because of an engagement, considering he's our restructuring expert. But we have a wonderful panel for you, a group of folks I think you'll find very interesting and very well positioned to talk about the subject matter at hand. I used to think of private equity, at least in the last decade, as the third leg of a three-legged stool. You had the bank market, you had the capital markets, and you had private equity, the latter of which would sometimes fill in for gaps in the first two. One wonders if that's still the case. We sort of heard Evan Ulick give a hopefully premature eulogy, but maybe not, for long-term, low-cost debt finance. And I listened to the capital markets presentations pretty closely, and I heard Doug Mavernack say, if you've got the right opportunity, you can do something. But I kept waiting to hear for a return of that word robust, and I didn't. So I don't know if we'll hear that during our presentation now, but I think it's safe to say that private equity has had a major seat on the table since the financial crisis, at least with respect to shipping, and everybody here has had something to do in that area. So let me introduce the panelists, even though I'm sure you know them all well. Peter Shaerf is immediately to my left. He's a principal of American Marine Advisors, AMA. They've been involved. No, he's not. Oh, he's which subsidiary do you represent? AMA Capital. All right, he's private equity, so it's AMA Capital today. All right. You're still a principal, though, right? Yes. Okay, got that right. And we have Art Regan from Apollo Management. Art, as you all know, has had an interesting career. He's been in the technical business of shipping. He's run a portfolio company and now manages Apollo's investments in shipping space, and probably does some other things he can talk about. We have Yohan Minaya of Evercore. I think Yohan's done a number of things. He's had done a lot of work in the M&A area. For those of you who don't know Yohan well, you should get to know him. He's a very interesting guy. I had the ability to listen to a very insightful presentation he did for a NYMAR program earlier this year, so thank you. And on my far left, your far right, we have Paulo Almeida from Tufton Oceanic. Many of you know Paulo and certainly know Tufton Oceanic. It's been in the business a long time. Paulo's responsibilities include principally portfolio management, so he's managing a lot of private equity money in the industry and hopefully can shed some light on what sectors he thinks are the sectors that will continue to see investment. But let's go back to sort of my original theme, is to where private equity is today. I think all of you would agree that we don't have as many investors sitting out there today as we've had in the past. While there was a big infusion of private equity capital immediately following the financial crisis, I think the second and third and maybe fourth waves of that capital have been smaller, more targeted, and maybe not the pure equity investments we've seen in the past. Peter, could you start us off and talk a little bit about your perspective?
Yeah. Is this working? No. Can you hear me? Yeah, there we go. Larry's right. I think there was a lot of money lost in the early cycles. I think people made bets. Private equity simply made bets. They saw prices down, tried to come in, didn't quite work. Then they sort of build portfolios, hire good men like Art to run them, because they thought they'd be out of them. You actually were never planned to have a job.
Yes, that's true.
They never really wanted
lucky.
you, right? And now the money that is there, we see looking at different structures, debt-related structures, preferred instruments, just other ways that they're not sort of first loss positions. And we're seeing it hard to find new money. There is new money out there. It's opportunistic, I think, as was sort of mentioned on one of the other calls, but it's much harder. this room's thinned out quite a lot from even a couple of years ago.
Yes, I agree. Is there anything you think structurally about the way private equity operates normally, whether it's the shorter horizon that they look at, traditionally it was a 5 to 7 year investment. Those private equity companies that got in shipping realized that short term became long term pretty quickly.
I think we've seen the can kick down the road somewhat. It's sort of, but a lot of the funds now that came in earlier in the end of that sort of 7 to 10 year cycle, we've partnered with Vade, as many of you know, and we're sort of loosening up on some of our investments. We just sold some ships, sold some other parts of the portfolio. So, private equity does have a time horizon. Art can probably speak more to that than
maybe
me.
You could speak to that, Art, and give us a little bit of background about what you've been doing.
Well, definitely the standard private equity investment in any industry is going to have a term life because they're operating off a bespoke fund that will have a time when they have to return the capital to investors. And shipping seemed like that 10 years ago, or when the kind of private equity boom started, because if you look back at that point in the previous 10 years, we had the golden years. Lots of liquidity, lots of value creation. As we all know, in the last 10 years, that hasn't been the case, and the liquidity and the market cap of shipping has been dramatically reduced, so the natural exit hasn't been there, and that's been a major problem for private equity. So I would say it's, as a broad stroke, it's kind of off limits. The shipping industry is off limits to the pure high beta, high return private equity for now, but the larger firms and what others have done, I think, over the years is expand the types of capital that are invested in shipping, and with that come much more investment in structured finance, things that you can actually depend on a little bit more than we could back in the late, let's say 2009, 2010, when it seemed like, okay, we're in a trough, this is a collapsed market, let's put all this capital in and get out, and it just hasn't really recovered for a number of reasons, some of which we'll cover later on. But I would say that the difference is private equity is much, much more disciplined now than they were, definitely looking for more structured investments. There has to be a plan. I think stress testing needs to be covered. You cannot just hope that the market is going to increase and asset values will increase. You have to have some kind of plan and strategy for liquidating or producing income even in a poor market. So I would say generally it's much more disciplined, more structured, but it's not the big ticket equity that we saw 10 years ago, and that's something that the industry is needing to get used to, and I think is and will, because it'll find its own path, and we're in the middle of that. So overall, I think it will be healthy, but we have a bit more to go to kind of work through the existing private equity that's still stuck.
Yohan, could you expand on that a bit? I mean, traditionally, we've all heard, those of us who aren't PE people ourselves, we've always heard that the PE folks are aggressive, looking for high returns. They want the easy exit. We've now heard a couple of people say that's not the case anymore, or at least the easy exit's not there. What do you think that means in terms of structural changes in the PE market?
Yeah, no, I fully agree with Peter and Art. Two things. One, I think private equity investors today are engaging in shipping, but they're a lot more opportunistic. There's no longer the case of easy capital as we saw in 2012 and 2013, and they're still trying to harvest those legacy investments. So one thing that they are engaging in today is those structured vehicles. One of the attractiveness is, as you've seen the European banks dramatically reduce their lending, they're entering, you see them more activity with respect to alternative lending. And obviously there's more of the risk-adjusted return, but the good part about those investments is if you are lending to a good ship owner with a good balance sheet, there's certainty in when you're going to exit, hopefully, and you know what return you're going to get instead of the pure equity plays that they did in 2013. And the other thing that I would say in terms of harvesting their investments, I think you'll continue to see a trend of more ship for shares transactions, especially with the PE guys who made a little bit more of the smaller investments. With the market where it is today and the trading liquidity, especially in the tanker market, you'll continue to see those type of transactions. And obviously, in terms of the legacy investments, the pathway of the traditional exit that PE guys see, which is one, either an IPO at a very attractive valuation. We know obviously that hasn't played out well and it's been shut. And two, there's really no cash player out there to do a full-on acquisition. The only thing that they're trying to work on right now is get a step closer to that liquidity. And you've seen that trend recently with CPLP and Diminished and with Poseidon and GSL. And I think as the market continues to improve, there should be more activity in that end.
Yeah, I'll come back to some of those themes, but I don't want to forget Paulo just because he's on the far end of the panel. You're actually managing the money that you've raised in a as a private equity manager and investor. Would you agree with what you've heard, or do you have a different perspective?
I don't think I disagree with anything that my fellow panelists have said, but we just have at Tufton, most of the capital that we manage, we just have a different investment strategy than traditional large generalist private equity firms and distressed investing firms have. So what we've been doing, and most of this has been over the past 5 years or so, when we've invested around $1 billion in institutional money in about 60, 70 ships over that period, most of which is in private funds and about a quarter of which is in a London-listed fund that we manage. We are buying vessels on a 100% basis with, in most cases, zero leverage, in a few cases with moderate leverage on some ships that have long-term charters. We have a diverse portfolio of ships. We have a 3 to 4 year average charter length. And we're generating 12 or 13% cash on cash unlevered yields on that portfolio. So it's very different from the traditional model of buy and build and then list. We're basically in structures where our investors are prepared to own the ships for a very long time, 10 years, possibly more. And as long as we're producing those types of cash returns, which are actually not far off historical averages in shipping, and we've been buying assets cheaply, for our investors, it's a very good diversifier from other asset classes that have become very expensive. So they think that real estate is expensive, it's yielding 4% unlevered, and they think that there's some downside in real estate prices globally. Infrastructure, renewable energy, aircraft, credit, everything is sort of priced for perfection, and shipping definitely isn't priced for perfection. Is there a little bit of downside risk? We're in shipping, of course there is, but if you have 3 to 4 year charter length, charter coverage, then you know that you're covered for a decent amount of that time, and actually the downside is fairly limited.
So you're still bullish on the investment of capital from an equity perspective in shipping?
Not universally. I mean, we think that right now is a very good time to continue to invest, as some of these legacy assets from banks and even in some private equity firms need to come to market at the same time that there are very, very significant supply side tailwinds, IMO 2020 forcing slow steaming, very few new build orders because no one knows what type of ship they want to own between 2030 and 2050 as environmental regulations kick in on an increasing basis. So the order book is very low. So we think buying fairly fuel efficient middle-aged ships, 10 to 12-year-old vessels, is a very, very good investment strategy at this time.
Thank you. Yohan, you mentioned the Diminished capital shipping transaction. Do you think that is sort of a model exit strategy for private equity investments today? Or you may have a view on this as well, or is it just too unique to be applicable across the board?
Well, Larry, I think if you're sort of alluding specifically to sort of a spin merger, seeing those trends again, I think, it was sort of a unique transaction, and hopefully we'll see more of those, but it needs to work for both parties. Obviously, CPLP being an MLP, where you had sort of middle age or older product tankers that were operating in the spot market, that's not conducive to an MLP. So that creative idea of a spin merger, where Diminished, you had a legacy PE guys like Invesco and First Reserve being there for a long time in the name, that worked, that idea of spinning and merging that transaction to get at least a pathway forward to liquidity. Did it solve Invesco and First Reserve's goal of monetizing their investments? No. Now they need to work on it, right? But I think the bigger trend is the idea of larger portfolios that PE guys own. I think you'll continue to see that trend of merging into a publicly listed platform. And you had Kelso, again, another one with a long time in the investment with Poseidon, and another one that tried to take it public, but the markets weren't there a few years ago. That was another creative way for them to get access to liquidity.
Do you think we're likely to see more consolidators like Starbuck, when it picked up very recently, Delphin's fleet? Do you think there's more of that that's going to happen? What do you think, Art?
I do. The public companies that have been able to grow much larger and increase their liquidity will continue to be active, I believe. It's kind of wide open for them because of the situation with so many equity sponsors holding on to ships. So it's a perfect solution. So I do think we'll see a lot more of that. The private equity investor who is holding assets has been kind of worn down. By that I mean their options have been dropping, like this private equity panel participants did before this morning. And so I do think we're going to see a lot more of that, and it's a very good thing, because when we talk about liquidity in any other industry, and we see 5, 10, 20, 30, 40 billion dollar companies, we've convinced ourselves that $1 billion market cap is a big company, need to be there. But in the grand scheme of capital markets, it's still an extremely small size. So the previous panel was talking about 2 billion, really the bigger the better. So those that do already have some scale and have some momentum, I do think will continue to be very active, and I think it's a good thing for the industry that they do so.
But I would, I would just sort of caution it, because I've seen it. I'm on the board of a couple of sort of private equity held companies, that there is a desire now, because of this lack of liquidity, because there are not that many big players able to consolidate, that you start, if you're going to lighten your load, start selling your assets as sort of onesies and twosies. And I think you will actually see more of those type of transactions, literally being done through the traditional brokerage network. Because I think there are a lack of potential consolidators, and everybody, it's price driven, right?
Piece by piece.
Yeah, I think
sale.
you'll see a fair amount of that as people start lightening up and taking money off the table.
But because of the valuation gaps with the public companies, it becomes an obvious. Right. Anyone's going to say, why would I trade into a stock that's at 60% NAV when I can just sell the assets? But how do you sell 40 or 50? It takes time. So I agree, we'll see some more trickle on individual asset sales in order to monetize at the right valuation. But the way the tanker market and hopefully other markets now are turning back up to NAV, it's really interesting how that might change that, because all of a sudden your value don't feel so injured from the valuation. But I agree. I think we'll continue also see individual asset sales.
If there continues to be this decoupling, if you will, of stock market valuation of a company and its book value or fair market value liquidation sort of analysis, why then do we think that there are going to be new structures from private equity and vehicles that are equity linked?
I think there's a lot of money out there that wants to be put to work somehow, somewhere. Yes. Shipping is still somewhat on the radar, but I think they've seen a lot of losses from some of your friends and some of your neighbors, that they want to try something different. I think some of the perpetual preferred that C-SPAN, for example, started on that right. type of thing. That type of structure has some sort of appeal to private equity. Yohan probably can comment.
Yeah, no, I would agree, and I would just add, we're still in show me mode, right? It's been a long time where all the verticals have been trading at a big discount to net asset value. It's just been in recent weeks. So hopefully, there's obviously strong momentum. We've heard the prior panelists speak to the market, but I think we're still in show me mode, and PE guys did learn their lessons from their 2012, 2013 days.
Paulo, you mentioned the kind of rates of return that you're providing on an unlevered basis to your investors. Do you think that's because of the sources of your capital, that's more modest than the big PE firms have sought in the past and distinguishes you?
Well, I think you always have to look at risk and return together. And I think that's something that is often forgotten in the shipping industry. So we're producing what I think we would consider moderate risk and return. At the same time, we have, zero to low leverage on the assets. And the key for an investment manager is to match an investment strategy with the right sources of capital for those types of deals. We're not going to go to a big private equity firm or the traditional sort of buyout team within a large pension fund with this investment strategy for shipping. And I don't think the traditional buyout model works where you're targeting 15 to 20% returns in shipping. The only way you can do that is either with a lot of luck or with a lot of leverage. And leverage in shipping, if it doesn't match your employment strategy, often works on the downside rather than the upside. So finding the right sources of capital for an investment strategy is absolutely key. So as I sort of alluded to before, a lot of our investors are looking for a segment that produces significantly higher yields than commercial real estate on an unlevered basis without too much more risk. And that's what we think that we've created.
A lot of young men and women fresh out of business school would come to you and say, why don't you leverage? Because you can always, with leverage, goose your return. And if I hear you correctly, what you're saying is that it also increases your risk and maybe affects the ability of the end user to generate enough revenue to pay that leverage?
I would, you mentioned business school, particularly. If someone were to say that, I would ask them to go back to the capital structure work that they should have done, Modigliani and Miller, in terms of why actually do you want to have a lot of debt in shipping? It actually makes very little sense because there's no tax in shipping. And one of the key...
Not for the moment, anyway.
Well, that could change, as could a lot of stuff in the current world and with the current world leaders that we have. But if there's no tax shield benefit to interest in shipping, unlike the other industries where LBOs do benefit from leverage, why would you do that? The other aspect is there's the incentive argument, which is that if you put a lot of debt on your company, your management team's going to work harder. That may make sense for a cookie factory because they can trim costs, they can come out with a new set of a new type of cookie. But in the shipping industry, are your guys really going to work harder to make an extra dollar on a VLCC in a totally commoditized market just because there's a lot of debt? It doesn't really make sense. You have to match the capital structure to the operating structure that you have.
Peter, would you say matching the investment to an appropriate capital structure for a shipping company today is more challenging, less challenging? As the banks have pulled back, what does that do to a ship owner's capital structure?
No, so I think as the banks have pulled back, certainly we've seen private equity coming into this sort of alternative debt type structures. I think you used a word earlier, robust, and I've always said until industry fundamentals are really strong, I think it's hard to attract people. Maybe everybody wants a VLCC today, right? Returns are good, right?
Yeah.
But I think we still lack the sort of, the fundamentals that are upside. I mean, good Lord, I've been at so many conferences the last few years where the dry cargo market is going to get better, in the next 6 months. And until that really happens and there's sustained recovery, it's hard to attract people to the business generally. And then when they come in, they're going to want the sort of more refined structures.
But once you've had the sustained recovery, then there's always the fear that you're at the top of the cycle.
Yeah, and then we get to the 300,000 VL, so it's there, Larry. You know it's there.
Yep. I think I mentioned to you all in an email recently that I was struck that the most recent Mergers and Acquisitions magazine, which is not a shipping publication, cover story was called "Spend It or Lend It," and it was about the dilemma facing private equity as to whether they should invest in companies generally, if they should just lend. Now, I don't want to step too far into the territory of our alternative investing panel this afternoon, but is lending a viable strategy for a PE fund, PE-sponsored fund? I think we've seen some in the past, but can you get the kinds of returns you want?
Yeah, I think the short answer is yes. As Peter mentioned, there's PE guys have a lot of capital to deploy. And at least if they look outside of shipping, maybe a lot of the other verticals, they're priced quite heavy. So when they look at shipping, where they obviously were in, as I mentioned earlier, pretty predominantly in the early 2012, 2013, I think when they, on the alternative lending side, in this low yield environment that we have globally, if you can still lend to a ship owner, let's say just getting up to an LTV of 60 to 65%, depending on the fleet employment, getting those higher, 9, 10% cost of debt, it is an attractive platform for them, and I think you'll continue to see that trend.
Art?
The idea of alternative equity in the debt markets is changing rapidly, and it's pretty complex. But by that I mean, when we look at the typical capital structure of shipping being 70% debt and 30% equity, that's now 50% or even 40%. Where is that additional capital coming from? It seems natural that, okay, private equity is going to step in, but to your point around matching the equity source with the actual product, you just can't do it. It becomes too expensive. It's not going to be a product that most shipping companies are going to be able to manage. So I think in evolution, at least I can speak on behalf of Apollo, the larger companies that have multiple sources of funding, like for example, Apollo is in control of insurance proceeds, and they have a few insurance companies that has probably the lowest cost of capital. So can that be applied into first lien senior secured ship lending at a rational margin for the ship owner, where that capital from our side can get an appropriate return? Yes, it can. Could you do the same thing with private equity that's still looking for 15 or 20%? No way, no way. So I think we're in a transition. Like, where is that additional capital coming from, since the debt markets are in the 40 to 50% tranche right now? So it has to come from somewhere. And I think over time, since the opportunity for new equity is expanding, although banks are recovering and there's been some new players, by and large, we're still looking at a gigantic dislocation from where we were 10 years ago from the debt capital markets. So I do think that slowly but surely the right capital will show up at the doorstep, and most of it is going to need a pretty modest return, because you just cannot stress a shipping company with 10% or higher debt for very long. So I think we're in a transition. It's going to take some time. And for example, Apollo is trying to access an entire new source of capital, and that's the insurance market. So we'll probably see more of that as well.
But the private equity returns have generally declined in terms of ability to get when we started with private equity coming in, it was always 20% plus, as a minimum, and then they gave all your projections a haircut and then another haircut, and they still wanted over 20%. I mean, I think it's a function of there being so much money out there chasing the limited number of opportunities.
It's a good point. So the concept of private equity funds is changing. They're more credit-oriented funds just because there's not enough 20% deals. So I agree. And shipping is caught right in the middle. It's, there's not much you can say. Where can you get 20%? It's not a common thing in the last 10 years. So we're going to have a shortfall.
So how much of the reticence of PE firms to get deeper into the shipping markets now is because their valuations and appraisals of the industry and its cash generation ability suggest you can't get 20%, you have to look at more modest returns? And how much is it because in 2008, 2009, 2010, it looked like a quick asset play and turned out not to be? Or is it some combination of both?
I think it's a combination of that, and also that there are enough firms now with institutional memory of capital put to work in 2013, 12, 14, In shipping, it's actually very difficult to put a lot of money to work if you're a mega fund. We have as friends in some deals some of the big U.S. PE firms, and they really don't want to look at a strategy unless they're pretty sure they can invest, say, $10 billion in it. That's pretty difficult. That's pretty difficult to do in shipping. So if you can put $50 billion to work buying shale oil fields, shopping malls, hotels, and there's no sort of negative institutional memory in those sectors or even in retail, why would you want to fight a massive uphill battle to try to invest $2 or $3 billion in shipping? And I think that's probably right, that the funds targeting 15 to 20% returns should not be investing in shipping.
Right. So what investment we see in the future from private equity is largely going to be much smaller ticket than we see today? I see nodding of the heads. Anybody want to elaborate on that?
No, I think absolutely. I think they got the wake-up call of how hard it is to exit if you made a big check. And as I mentioned earlier, and as other panelists have mentioned, the ship for share trend, I think, will be prominent in the coming months and next year as valuations have gone up. That's an easier way to exit and hopefully get a higher return. And as Peter mentioned, and if it doesn't work out, hopefully with a smaller scale platform, you can sell in block, sell at an opportune time in the cycle, and you're just your traditional S&P broker.
Thank you. Art or Peter, did you want to elaborate on that?
When we're talking about credit-oriented funds, it is so much different than pure private equity, which is the high yield. So the credit funds you can have a fund with a slice of 6 to 7%, or 8 to 9%, or 5 to 6%. It's a very specific type of returns. You can't do $1 billion of that in shipping, as we heard, but you can do a structured deal that's a much smaller ticket and put a contract on it so that it's pretty predictable. So I think, yes, that most of the alternative equity that we're going to see is in more smaller ticket structured deals.
The billion-dollar deals have gone into the offshore industry where we've made a good living doing restructuring, so we're happy for that.
Yeah.
As Paulo said, you can't put $1 billion to work in shipping.
It's sort of, to me personally, it's sort of interesting because, as you can tell from the color of my hair, I've been doing this for a while. Some of the first transactions I ever worked on were deals that were either funded directly or indirectly by insurance companies or pension funds. There was pretty much a direct institutional market into the industry, which got supplanted largely by banks who were nimble and able to move quickly, and were comfortable doing sometimes shorter term or medium term or longer term deals. So times have changed. We have just about a minute left. Anybody have any questions for our panelists? Seeing none, well, I have no further parting thoughts. Anybody here want to say anything in our last 24 seconds? No, I won't put them under any pressure. So thank you very much. Thank you, Nicholas, for inviting us all to be part of this presentation today.